let's go ahead and get started. My name is Julianne Peterson, and I welcome you to tonight's Zoom at 8. We are starting tonight on time, as we always do, and really encourage you to come early. I start about 15 minutes early, and you get to spend a quiet time here in the studios of Zoom at 8. Now, as you know, I'm a commercial loan officer for Old Capital, and we are a little bit different than the rest of the mortgage lenders out there because we educate you. We are your biggest partner. We've closed $1 billion a year, and there's only like 10 of us. So the difference between Old Capital and some of the other mortgage lenders are out there is that they show up and they ask for their commissions. Whereas Old Capital, we bring lots of investors, we bring sponsors, we bring our insurance brokers, our attorneys, and relationships that will help you in the transaction. So keep us in mind if you're working on multifamily or storage, industrial, office, retail, mobile home parks, this is what we do. The majority of our business is in agency debt, so we can talk about that further when you have a transaction. So tonight, you know, we've been doing this for over a year, and we have expanded our outreach to both sides of the country. Now, our next guest, and here it is. He's from Montreal. Here we go. He got started investing in real estate and business in 2002 and left the corporate world in 2007 and became a full-time investor, a passive cash flow investor. He currently is an investor of more than 60 opportunities across more than $1 billion worth of real estate and business assets. As founder and president of Roll Investment Group, Jeremy manages a group of over 1,500 investors who seek passive managed cash flowing investments in real estate and businesses. As I mentioned, Jeremy is the co-founder of this For Investors by Investors called Phoebe. It's a nonprofit organization that was launched in 2007, way before this silly Zoom thing came on, with the goal of facilitating networking and learning among real life investors. And it has a strict no pitch environment. So Phoebe is one of the largest, as I mentioned, 30,000 members in the Los Angeles area. Jeremy has an MBA from the Wharton School of Business, is a licensed real estate broker, for investing purposes only, and is an advisor for Realty Mogul, the largest real estate crowdfunding website in the United States. So Jeremy, thank you for being here, making yourself available to these cast of characters tonight on Zoom at 8. You have a lot of people following you, and you now have 65 more people. So it's really exciting to have you here. I appreciate you taking the time away from your family, and welcome you to this special group of investors. Yes. How are you today?
Thank you for having me. I appreciate it. I just hope that whatever we talk about tonight is helpful for everybody, bottom line. So thank you for having me.
Absolutely. So as I mentioned, I want to know what a day in the life of a full-time passive investor looks like. Can you take us from start to finish outside of COVID? Because, you know, it's easy to put in your Facebook page that you have a W-2 and I'm an investor, but really, as a full-time investor, what does that look like?
So it's a good question. And I would say it really depends on the philosophy of investment that somebody takes, even if they're passive. I'm on one extreme side of the spectrum because I am hyper diversified, I call it. So it's not something I recommend for anybody, to be honest. But I mean, I'm in over 60 LLCs right now. I've easily been in over 100 in the past, almost 19 years. I was in over 30 sales in the last 3 years alone, just to give you an idea. And I think that the diversification I have, which I happen to love, is a little extreme. But when you get to that level of diversification, it creates a lot of work. And had I chosen, say, 20 or 30 LLCs as a target or whatever it was, it would be a little bit easier, to be honest. So I work a lot. Really, I do a few things every day, same stuff, which is I try to network to find opportunities. And that could be with other investors. It could be directly with sponsors, and it could be with investor groups who have opportunities. And so I'm just constantly networking to find opportunities. Even with the advent of the internet, crowdfunding, 506c publicly available, opportunities and the rest, I still find the networking is really what is the most important thing I can focus on. And if you think about my number one goal, I left the corporate world back in 2007, and my number one goal since has to continue my cash flow stream so I never have to go back to the corporate world. So the networking is really what facilitates me finding opportunities, which what enables that cash flow snowball to kind of get bigger and for me to never have to go back. So that's my number one focus. Now, I tend to be a bit more of a kind of type A personality. So I'm not the guy that's just going to go take the day off and go to the beach. I just can't do it. So, because I'll feel like I didn't maximize things and everything. So I work really hard and just try to maintain the largest network possible as best as possible to continue to find opportunities. That's kind of outside of COVID. COVID has definitely kept me on the sidelines. And, philosophically, I'm very low risk. For people who know me, they know like I've been on the sidelines since the end of 2016, which is when I was very concerned about cap rates and really pushing my sponsors to sell. And that was just kind of an end of the cycle type of strategy. And with COVID, with a lot more uncertainty, even, between stimulus and not knowing if that's going to go, recession or not recession, vaccine or not vaccine, and all the rest of it, I've been pretty much, I still make investments, but they're all unique. But otherwise, they're just sitting on the sidelines, not looking for something that's what I call market rate at the moment, and hoping to jump back in at the beginning of a new cycle fairly shortly, depending on how things unfold. So I'm currently on pause, and I've been mostly on pause for a few years now. And I did the same thing, I started in 2002, and I did the same thing between 2005 and 2008. And these multi-year waits are a very agonizing period for someone like me, because my cash flow snowball actually decreases as stuff liquidates and I can't deploy all the capital. And it's very annoying. And I go through this like multi-phase, anxiety and all this over time. But in the end of the day, real estate investing is cyclical. Timing is very important. I just am able to kind of persist and stay on the sidelines until it makes sense to come back on. So that's my general mentality at the moment, hopeful that maybe I'll find the odd opportunity that's unique and makes sense in the interim. So that's the quick summary.
So tell me a little bit about what your, first of all, let's talk about when you left your W-2. You had it all set up, I'm assuming, right? That you were cash flowing enough from your investments.
Well, yes. Let me actually talk about that, because I was not, I come across some people who have like a 5 or 10 year plan to get out of the corporate world, and I love watching those people go through that and actually get out, because it's just really your whole life changes. And but I was not one of those people. I did not say, okay, I'm going to rotate into cash flow, get out of the corporate world in 5 years, and then just try to stay out. In fact, my goal was to have more predictable cash flow for my retirement, or more predictable returns for my retirement. So I kind of left the stock market and stocks and bonds in 2002 after the dot-com crash. That's what was kind of the last straw for me as far as lack of predictability and too much volatility. And so when I left the corporate world in 2007, I actually wanted to continue on with the W-2 and the cash flow. But I had a last straw moment in the corporate world with one of my managers, actually at the time at Toyota headquarters. And I decided to take a risk and leave, because I had a certain cash flow coverage to live off of for a couple of years. So I gave myself that runway for a couple of years to see what would happen. That's what happened with me. This was not any magical plan and smart plan to get out for sure. But I love watching people take that approach, and I've seen it happen over and over time. And I love it just because I know how your life changes, and it obviously, if you want to get out and you manage to, it's a very positive change. So
would you say, because I think there's a lot of people out there that put investor under their name on Facebook and LinkedIn, that I'm only going to need to work 5, 10, 15 hours a week. You're a full-time investor. You're not doing a lot of investing now. In COVID, what do you say? How long does that take? How much are you taking to invest?
Yeah,
in your
so
business?
I still do full-time days. And in fact, to be honest with you, my network has gotten so big that part of my challenge is trying to figure out how to reduce the workload. So I'm typically on the computer till 10 o'clock every night. And granted, I do dinner with my family from 6 with my kids till like 7:30 or 8. So there's 2 hours where I could be shrinking that timeline. But the bottom line is I am working very, very hard, but that's a choice. So I do think that if someone wants to make the choice to actually be in less opportunities and not maximize their, things all the time, that they probably could do, I would say, even a pretty good effort would be 3-4 hours a day, and you're going to get pretty far, I think, if you're networking that much and if you're doing that much research. I think one thing people have to understand about this, though, is that once you get down this path and you accumulate a certain number of investments, eventually those investments sell, right? Or they exit or they end, whatever the case is. And the problem I have, for example, is that I have a lot of things going on all the time because I'm in so many things. So, for example, I'm actually even trying to count it in my head right now. So one exit, hopefully in the next 2 weeks, another one in January, another 2 or 3 by the end of the year, hopefully, right? And then I have this current, I have a spreadsheet I created last week because there's a lot going on right now. And I was like, what's actually exiting in the next few weeks, and what am I trying to get into, and how does that actually balance from a numbers perspective? How much should I go into each deal? How much do I want to keep back? And all kinds of other things. So even today, I'm dealing with 5 or 10 different things out and 5 or 10 different things possibly in, and trying to sort that out. And it's just middle of COVID. I'm not looking for anything, right? But that's also a product of the fact that I've been in many things over time. So somebody over time eventually gets more busy. If you end up with a well-diversified portfolio, at the beginning, it could actually be less time for sure. If someone's starting in the first 2, 3, 4, 5 years, it's less time. It could be less time a lot more easily because you're not dealing with the cash outs and the reinvestment pressure.
Now, these that are coming, that are going to be exiting, are you going to be, if they're coming out of industrial, are you staying in the asset class where they're coming out of, or do you kind of go over those lines?
Yeah, I go over the lines all the time because I would love if I could sit down and create a chart and a pie chart and say, this is exactly what I'm going to do. But the reality is it's not the way that it really works, because I don't know what's going to come to me, right? So, I'm looking at an ATM opportunity for January that just happens to be available for January, right? I'm looking at some hard money this month that just happens to be available today, right? But I don't pick and choose. I can't say I want to go into 2 mobile home park deals, 3 self-storage deals, and 2 apartments in the next month. That if I did that, I think the challenge would be that even though I may find stuff, that may not be the best stuff to invest in, right? It would almost be like pressure to conform to the slices of the pie. I work the exact opposite way. I react instead of proact. I'm very proactive in trying to find things, but then reactive in terms of what actually makes sense and determining what I should reinvest into. So it's almost impossible to actually be optimized all the time, right? Because if you say to yourself, I want to have 21% of my money in mobile home parks, that could work for maybe a period of time, but it's not going to work in the long term. It's just not. It doesn't work like that.
So let's talk a little bit about that. What do you share? What kind of percentages you have your assets in now? Is that something that you share?
Well, oddly enough, I don't even track it, to be honest.
Oh, wow.
Yeah, I mean, because I'm in so many things that I'm going to get a very good level of diversification. And I tell you what, and the percentages wouldn't be secret. I have no problem with it. The amounts would be a different story, right? Just personal, but the percentages are no problem. It's what's more important to me is actually to think 5 or 10 years ahead today to determine what should I be going into now and in the next couple of years. So for example, because I'm looking for more predictable, stabilized cash flow, that's just what works for me personally. I could tell you that what I've identified for the next 10 years, high level, are apartments, senior living, mobile home parks, and self-storage. And I can go through each one, but to me, those are kind of my tier A target asset classes for the next 10 years if I want to look for the maximum amount of predictability, okay? And it doesn't mean I'm going to invest in any of those today, and it doesn't mean I'm going to do any type of class, and it doesn't mean I'm going to do any location or any sponsor, but the point is high level. So what's more important to me isn't whether I'm in 21% mobile home parks today, it's where am I going and what's going to get me there, right? So that's what I know to focus on more now for the next few years based on those conclusions I've come to versus what I've done in the past. Because I could tell you I'm in a whole bunch of retail strip centers, and that's from past, and I'm still in them. And frankly, they're performing okay today, thankfully. I think I was going to say for the most part, but all of them at the moment. But it's not, that doesn't mean that I should be investing in another one, next year or the year after necessarily, right? So that to me is even more important than the current breakdown of what I'm in. And that's not, and I'm not answering that to avoid the question, even though I don't have an answer for you. I think it's actually really an important focus. And I don't know that a lot of people, I think one of the things I find about passive investors is that they're not always, a lot of people are not focused long enough term, in my opinion, because as a passive investor, you're getting locked into a deal, and you could be locked into a 10-year loan, right? And then you're really locked in because it's a liquid investment. But if you're not thinking about the trends in society and whether or not you need to be worried about an asset class in 7 or 10 years, I'm going to give you a great apartment example in a minute, then you could potentially be shooting yourself in the foot. So here's an example. I tend to target Class B apartments, and I actually have a lot of investments in Texas, and I love apartments in Texas. And I'm not just saying that because everyone's going to make everyone feel great on the call, but it's true. But a sponsor told me a few years ago, they said, we're not doing any more deals Class B that don't have a 9-foot ceiling. And I said, well, what's that about? And they said, well, think 10 years ahead. These millennials are coming up. They want higher ceilings. And when I go resell that building in 10 years, if I have an 8-foot ceiling, it could be worth less. Or it might not be considered to be Class B anymore. Okay. But just one little nugget, right? Really important though, but you only get that if you think 10 years ahead, not even 5 years ahead. And that's how, so you're trying to avoid a lot of the landmines, and you got to think way ahead in that. So I'm sorry I shifted the answer to like thinking ahead instead of current, but I just think it's such an important topic, It
is fabulous, really interesting. Could you go through that one more time? You've got apartments, senior living, self-storage, and
mobile home parks.
Okay, mobile home parks. Okay.
Yeah, and I clump RV parks in there as a kind of a subset of those, but that's also in the categories.
Okay. Let's shift and talk about how you choose a GP to invest in. Can you tell us, first of all, how did they get to you? Are all of these syndicators just sending, I heard Jeremy, he's got a lot of money, let's send it to you? Do you have a connection first? Tell me kind of your steps to finding your investor GP, your sponsor.
Yeah, good question. So the starting part's easy. The harder part is explaining how you go through the whole process after, because that could be a very long topic. But so networking is key, right? So, there's two different ways to invest passively. Either you network and you find opportunities, or you depend on others to find deals for you. And what I mean by that is you can go onto a crowdfunding site, you can become part of an investor group. The challenge with going through the latter is that you're then saying, okay, someone else is going to, vet and find deals for me, but I'm going to actually get a lower return because there's an intermediary. That's a typical model, right? And there's nothing wrong with that. If people are busy in the corporate world, if they don't want to network, they don't enjoy it, that's another model. But I avoid that latter part because I spend all my time networking, right? So I'm trying to find the sponsors directly, and it's just a lot of networking. So there could be deals come to me from other investors that I network with who say, have you invested with these guys, or check out this deal? This happens all the time to me. And keep in mind that I have the benefit at this point of having networked a lot for 19 years. So the networking is, I wouldn't say it's necessarily easier today for me, but if I didn't do anything tomorrow, I still get a lot of stuff coming to me. Whereas if you're brand new, that's not necessarily going to be the case, right? So and that's just the benefit of time. That's just time. So I also do have some sponsors who approach me that may have been referred by another investor or investor group to me. And then I network a lot with investor groups because they tend to look at sponsors too. I might be able to invest in some of their deals. I kind of network. So there's all these different ways that I kind of manage it. But you guys on this podcast or this live stream already have heard me say the word network like 100 times. That's how important it is to me. That's my primary focus. So that's how I'm always finding. If I trace back how I invest in everything, it's always through networking of some type, okay? Because what I'm not doing is going onto Facebook and clicking on the 506c ad of this $100 million fund that's someone trying to like get all these investors to. I just don't, that's not what I do. So it's all networking. As far as how I choose a GP, I'm going to try to keep the answer somewhat high level just because that could be like a huge, long discussion. But what I've concluded for myself is that I'm trying to find someone who matches my personality. So I want to find someone who is conservative, who has basically created very conservative projections and who's experienced, but conservative, so that when I look at their opportunity and I look at their numbers, I feel like they've underpromised to potentially over-deliver to build long-term relationships with investors. That's one type of mindset, right? The other type of mindset that I see is someone who's just using really big numbers, trying to market and find as many investors as possible right now, less concerned about long-term relationships, will use their marketing machine to find the next investor the next time, regardless of how the performance is. I'm trying to avoid that, right, in a nutshell. And I like to tell people that analyzing the asset you're investing in is absolutely critical, but I really find who you're making a bet on is even more important than the actual real estate asset itself. And so I spend a lot of time trying to get to know who I'm investing in, who I'm making a bet on. That involves a lot of questions, a lot of phone calls, background checks. It's mandatory for me, which most investors I don't find really do, but I think it's really critical. And I also typically won't invest with someone unless I've met them in person at least once. And the reason why that is because to me, you're taking all these steps and then you're going to have a gut check. But I don't feel like you could do a proper gut check unless you met someone in person at least once. Now, I say this, and honestly, I haven't tried the Zoom route very much for this yet. I haven't tested that out because, this is all pre-pandemic and post-pandemic thought process as far as travel and stuff for me. But I still probably am going to want to meet them in person. And that's an important step for me too. So those are some of the high levels. They've got to match what I'm looking for. I create a very specific target criteria and box that I'm targeting to invest in. And I think that's very important. And philosophically, the people that I end up investing with many times are very much on the same page with me in terms of timing, type of asset, how conservative they are, the type of sensitivity analysis they've done. I mean, there are some sponsors I invest with who, like, if they bring me something, there's like an 80 or 90% chance I'm probably going to invest with them because we're so on the same page that they'll have already taken all the same steps I would have thought of, and they would have checked the same boxes, right? So ultimately, that's the best case scenario you could find, I think. But each person's going to have a different target. Each person's going to have a different way of investing. There's 1,000 ways to invest. Nothing's wrong with them. But sizing up who you're investing with is really, really critical.
Yeah. And turning on your camera when you're on a Zoom call is critical because we want to make eye contact. And by the way, you are always welcome to come here because we may have something that you want to invest in. So I always make that an option for you, Jeremy, because we could certainly use your help.
Okay, thank you. Thank you.
A couple things that actually three things that came to mind. I always hear, well, I underwrote it very conservatively. I hear that all the time, and so wouldn't it be the assumption that everybody is doing it conservatively? I mean, I whenever I hear it, I'm like, yeah, everybody says that.
Well,
what's your thought on that?
Yeah, so the key is to just put that aside, right?
Do you see it? Do you see that?
You have to figure it out for yourself. And I can give you some examples of some ways you could do that, but you've got to actually come to your own conclusion and not just take for granted what someone's telling you, right? So you have to kind of trust but verify is what I say. So for example, you may not agree with the exit price that somebody has assumed, which can have a huge, difference, make a big difference on the bottom line returns, the annualized returns. You may not agree with the vacancy rate someone has chosen for a specific market, or even just the philosophy behind the vacancy rate someone's chosen. It's just not on the same page with you at how you would have underwritten it, and then you would pass. There's a lot of different things I could point to, but you really have to do your own analysis and come to your own. I can give you a lot of different examples, but it's really critical you do your own analysis. It's to make sure you understand exactly what you're getting into.
Excellent. Do your timing on each of these asset classes, are they pretty consistent where you want to get in 3 to 5 years, or you're saying that you like longer holds? So how does that go across your asset classes?
Yeah.
Curious.
Yeah, so actually I look at it a little differently. So I actually will vary what I'm investing in depending on where the timing is in the cycle. So for example, at the beginning of a cycle, I'll do more value add. And I will avoid value add at the end of a cycle, which ironically is actually almost everything you see at the end of a cycle is value add, but I specifically stay away from it. And I can explain why. But and so, which also means that I'll be more open to doing a 5-year term loan, for example, on a deal that's more value add at the beginning of a cycle, but I'll specifically stay away from it at the end of a cycle where I'll typically try to target a 10-year fixed rate loan, for example, and have more predictability. Generally though, apples to apples, I try to target a longer term fixed rate loan because you got to remember my own philosophy is to have more long-term predictable cash flow. And if I have a locked in 10-year interest rate, that's going to be more predictability than a 5-year locked in interest rate, for example, or even a floating rate, for example. So you can already see that I'm just trying to match what's best for my personality to what I'm targeting essentially. And by the way, I completely think that a 5-year loan makes a sense on a lot of deals. And a lot of people who do a 5-year loan refi, cash out, even a shorter term cash out, they're probably going to do better for me than me long term, just a probability perspective from an investor, like just numbers. But I'm trying to match my personality in terms of what I pick, right? And that's, I'm a lower risk guy, so that's going to fit my personality better, even though I'm not going to do as well as the next person in the long term.
Tell me about markets. Do your markets go in line with each of the asset classes? Like, are you going to go storage in Atlanta along with your apartments, along with your senior living, or are you parsing those out depending on what the market is?
Yeah, so it's funny because I am not the kind of person that says, I want to invest in Seattle. I'm just making this up, right? Seattle, Dallas, Denver, and Charlotte, right? Just to take random places. I do the exact opposite, actually. I say, where don't I want to invest, right? So what I don't want to invest in, just because of my personality, is very volatile markets like California, where the pricing goes up and down a lot and very expensive because the cash flow is lower. And I don't want to invest in hot markets. So, and I'm not nitpicking on Texas, but like Austin is a great example. Very hot market right now. A lot of people are moving there. That wouldn't be a good single family market for me because I'd want to stay away from what's hot. Seattle and Denver, I love those cities. I've been to both of those in the past few years, but I've stayed away from an investing perspective because the cap rates are too low, cash flow is too low because they're hot markets, right? So what's more important to me is to stay away from what I need to stay away from, and then I have an open mind to everything else because I have an interesting perspective on this because I come from Montreal and I lived there for half my life, and I've been in the US for half my life, and I've actually managed to get to like 43 states looking at different opportunities and just in traveling and stuff. And what I've seen over time is the US has amazed me at how many markets I would have never known about without an open mind that actually are really good investing markets. But again, if I'm looking for kind of like an A- or B market for a Class B asset, then there's a lot of B markets out there that I need to be open-minded to. So to me, it's more a question of excluding what I shouldn't invest in, and then look at everything else as opposed to target certain markets.
Interesting. So tertiary markets, COVID has changed to tertiary markets. It's not hot, but it's shifting to some of this. I'm curious what your thoughts are moving forward into the new year.
Yeah, so because I think very long term and I look for the more predictable long term, I would actually personally, I would consider tertiary hot because it's in right now, right? And the way that I think is that, if everybody believes that vaccines are going to bring things back to normal in the next 12 months, for example, then I'm thinking in 24 months, what's going to happen to tertiary markets? They could get a shift away from them. Maybe they'll stabilize. I don't know. But I don't want to be taking that type of risk if I'm looking for more predictability. So for me personally, not a good fit. Maybe a great fit for someone who's trying to get in and out in the next 12 months, for example, though, right? So it all depends on your philosophy. But for me, I avoid tertiary markets, not just because of COVID, but in general, they tend to, especially at the end of a cycle, be the most attractive from a returns perspective. The cap rates are going to be highest and the cash flow is going to be highest, but they also have the most volatility once we have a downturn, so they can swing back. And I'm trying to avoid all that volatility. So tertiary markets for me, I try to avoid in general.
Interesting. Very interesting. Tell me, do we have any red flags? Do you have any red flag stories? Do you have things that you either invested in or thought about and you watched it and was a real complete failure? Can you share any red flags for our listeners that you look for that now not going to do?
Sure. Yeah. Well, so the first thing is, for me, background checks are mandatory. If somebody won't give me their information to run a background check, to be honest, if they're not John Smith, I could probably still look them up without even getting any of their information and figure out who they are. But I probably won't invest with them if they're not going to give me their basic information to do a background check across all the managing members of that opportunity. So that would be a red flag for sure. Another red flag would be someone who I think is taking an unfair split. Meaning that, I'm looking to have a win-win partnership with the sponsor who's properly motivated to make a fair amount of profit, but I'm also not looking to have the same risk for lower returns for myself, right, compared to the next deal. So if I find a deal that's below a 50-50 split, which happens like once or twice a year, I'll see a deal where the sponsor is taking 60 or 70 or whatever, it's more commonly 60 investors get 40, I immediately walk away and will never consider a deal from that sponsor ever, because sometimes I see people starting like that, can't raise the funds, and they switch their fund to, let's say, 60-40 the other way. But that tells me that I'm not on the same philosophical page as that sponsor, because they started from a place where they were basically working out of what I call like a principle of scarcity instead of abundance, right? They're actually trying to get as much as possible for themselves versus at least being fair to both sides. So that's another red flag, big time for me. Another thing is an immediate pass for me is if there's not a preferred return. And I realize that doesn't apply to everybody here probably. That's a very big rule for me. I'm actually more worried about downside protection with that, and I can get into why, but versus just getting that minimum return. It's actually more about the downside protection for me in case something goes wrong. So having a preferred return is mandatory for me, and part of the reason is because most of the deals I see have preferred returns, and therefore I can find that more easily, and it gives me a little bit more downside risk. So that's another red flag for me that just won't work for me immediately. I had never invested in a development deal in 19 years, so that would just be an immediate pass as well, or anything major value add just doesn't fit for me either. So those are some quick ones. Easy red flags too is like, you buy something at a 5 cap and someone's assuming you're going to exit at a 3 cap, and they're just using a ridiculous exit value to make the numbers look bigger. If they're so obvious when you look at them immediately, it's an immediate pass, not worth spending any time on whatsoever.
That's interesting. How about acquisition fees? What's your thought on that?
Yeah, so everyone has an opinion about that for sure. I got to be honest. First of all, it depends on the size of the deal. So if somebody brought me a $1 million acquisition and they wanted a 3% acquisition fee, to be honest, I have no problem with it. I know some people have a big problem with it, but it's absolute dollars. It's not a lot of money for the work they have to put into it. If somebody brought me a $200 million fund and they were taking a 4% acquisition fee, that would be a non-starter though, right? For the exact opposite reason. Yeah. So I am absolutely okay, let's say up to a $25 million deal, going up to like even a 3% acquisition fee if I needed to. And I know probably a lot of people don't agree with that. But if everything else checked off, I thought all the other fees were okay. And, there's a lot of work that goes into these deals, especially if it's a large sponsor who does a lot of volume and a lot of deals. Those fees are going into like them being able to find more and more deals, go hard on them, have the money necessary to do that, to actually acquire more stuff. So it depends on the sponsor, and especially if they're very experienced, I have less issue with it. If they're brand new, I'm going to have less tolerance for fees and splits and prefer return and everything if they're brand new, right? Because then the risk is higher. So it depends on the scenario, but I have no problem with up to, let's say, a 3% acquisition fee. The way I look at it is if the next person is okay with up to a 2% acquisition fee, then all they're doing is reducing the risk by 1% of their capital. In the end of the day, that's not a very big difference, right? You got to look at the experience and all these other things. So that's my take on it.
Yeah, interesting. So my curiosity is, we interviewed you at the Old Capital Conference, and you were talking about new president, stimulus, COVID, vaccine. We've got a new president. We've got, the vaccines on the sidelines. What have you changed? What has that? Now you've got a little more confidence. I'm going to say in quotes, you have a little more confidence. Not knowing what was happening back in October, and now we are here today. Can you share with us how that might have changed, how it has changed moving forward now that we have a new, some new things going on?
Yeah, that's a good question. So, I think that confidence is probably a fair statement, but I would say even more so is that what I was waiting for to even consider getting back into things properly is a new cycle to start. And what that was going to take is probably a vaccine. It was going to have to be determining who the president was, right? So I had a whole bunch of hurdles that had to be overcome. And I feel like if I'm running a race, I've jumped over a couple hurdles, but there's still some hurdles in front of me. And I don't get to the finish line until those hurdles are passed, right? So the hurdles that remain are stimulus, first 100 days of the presidency, and how the market reacts to whatever that is going to happen as a result of those. So while I have less hurdles left to get to where I want to get to, which is to start to invest again without as much concern, I still have to get past these hurdles. So I guess you could say as I'm closer to the finish line and being able to actually start the next race, but I'm definitely still in the race, and still has to be, those hurdles have to be overcome.
Yeah, interesting. All right, we're coming to, I've got a ton of other questions, but I am curious of two things. One, what are you doing for your kids to invest? Are you taking them with you to show them how you're involved in investments? Is this something that the family sits down and makes goals? Tell me a little bit about that.
Great question. So I have two kids, they're 13 and 10, and they're very different people. So my 13-year-old will soak stuff up like a sponge. He just watched 4 videos I sent to him last night on investing, just as an example. And sometimes I'll walk him through them and explain them as he's going through them. If I think they're easier to understand, he might just watch them on their own. But just to take a step back, so the first thing I definitely recommend is something called Cash Flow for Kids. It's a board game. It's made by Robert Kiyosaki. It's part of the whole cash flow, Rich Dad, Poor Dad, and cash flow quadrant type of series. The problem with Cash Flow for Kids is that, and there's actually a Cash Flow for Adults board game as well that most people have probably heard of, but just a cash flow board game is what they call it. But a lot of people don't know there's Cash Flow for Kids. Cash Flow for Kids has been out of production for a long time. I think there had to be some kind of partner dispute or whatever. I had to buy it on eBay for like $130 or something insane, right? Totally worth it. I'd spend 5 times that amount of money today knowing how worth it it's been. So I ended up taking my older son a few years ago through that game. And then eventually he's now been playing Cash Flow for Adults with me, because it really is a different, it's a real step up. It's much harder in terms of understanding. So that's one thing I'd strongly recommend for anybody. You'll find Cash Flow for Kids used copies on eBay and Amazon, and it's something that you should consider for your kids as well. I constantly try to share philosophies, videos, and other things with my older son, who's like soaking it up. This summer, even from a stock perspective, we actually, because he wasn't in camp, we created a fake portfolio on Investopedia for him, 100 grand, not real money. And he went at it, and he was learning a lot of lessons every day of volatility and stuff. He chose stocks. We watched it every day. And now we're going to start to do the real thing with him in very small amounts. But, so definitely taking that step as well. So that's with my 13-year-old. My 10-year-old is still a little young, and he's also not as open-minded. So I haven't really groomed him that much yet. But a lot, as people know who have kids, it really depends on the personality of each kid. So those are some things that I do. Yeah. My older one's old enough now that if I'm watching a video or seeing an article, I could just send it to him. And I've already spent the time to find it. I've already spent the time to watch it. It's going to take me very little time to then send it to him. So he has an email. I send him stuff all the time.
That's fabulous. Love it. I've got a couple more questions. You're in California. You do not invest in the great state of California, said nobody. Are you going to stay here with the wealth tax if it comes together?
Yes, California. So I would have left LA specifically and California in general probably about 2007. Had I had a choice, and we considered that at the time, my wife and I. But her family's in LA, so I'd say I've been stuck here. The best I've been able to do is probably get the okay to move in the next year or two if I'd like down with everybody to Orange County or San Diego. But getting out of California is something I love to do, but it's not something that's in the cards for me right now.
Okay.
Yeah.
Well, we're in Carlsbad, so you're always welcome to come down here in San Diego. We love having visitors.
Yeah, actually,
as long as you go. No, just kidding.
I just have to say this because this is going to shock some people, but I was on the phone yesterday with another investor friend of mine I know very well, who lives actually in San Diego, and he said to me, "I'm about to move to Nashville in the next year or two. Guess how much I am paying in California taxes?" Like he said, if I want to go buy a house in Nashville and take the money that I was paying just in state taxes and put it towards a mortgage, guess how big of a house I can afford without spending any more money, right? Because it's either going to the California government or to the mortgage in Nashville. The answer was he could buy a $3 million house, which is like some crazy house in Nashville, okay, just without spending any more money. He just was going to take the taxes from California and apply them to the mortgage in Nashville, where there's no state tax, he told me, and that was it. So California is getting tougher and tougher to to kind of justify, and I mean, I'm the wrong person because I can go on about this, but like between, there's a lot of bad stuff happening right here. There's a lot of crime increase because of COVID. There's more homelessness. There's all kinds of challenges. It's tough to raise kids here. It's way overpriced. I can kind of go on and on. So you've gotten me started. I'm going to try and stop.
Yeah.
So.
Okay. I won't let you go. All right. So I've got two questions. I told you I had two questions ago, but would you be investing in new syndicators like Jennifer Barner, who has an active deal right now? Is that not, let's just put Jennifer aside, but knowing that there's a possibility, is that something that you could think about, or that you do rather?
Oh, good question.
New syndicators.
So, yeah, and we're definitely putting Jennifer aside here. I don't know her, and so this has nothing to do with her. But
Yeah.
The way that I work is that if I meet someone who's quite new, and to me, someone who's quite new is, let's say, who's done, let's call it 5 to 7 deals or less, okay, in what I'm hoping I'm going to invest with them in. So call it apartments. I'll track them. I'll watch them. I'll specifically get to know them, decide if I want to get on their distribution list. And if I do, I'll definitely ask to be added on. I will then get every new deal they have, look at it seriously, watch and track what they're doing. And then when they've done enough deals to my comfort level, which is typically, preferably 7 or more deals, then I'll potentially jump in. Sometimes it'll be slightly less. So I am just really prudent because I'm really low risk. So I prefer that somebody takes some time to, get through a few deals and learn some stuff as they're doing it. So that's how I handle that. But I think there's an enormous plus into meeting people early, getting to know them, getting to understand them, and really understand their philosophy, and then stay on their list. And then, there's a huge benefit to watching someone do several deals, tracking them over a couple of years or a few years, and then jumping in, because you're going to know them so much better at that point than some random person you're going to meet tomorrow who has a deal in front of you. So there's a huge benefit to doing that for an investor in terms of reducing risk.
Excellent. So here is my last question. Do you have any advice for these limited partners who I always say get into at least one before you go be a syndicator? What would be your advice in buying apartment buildings per se?
So my advice, someone who wants to become a general partner or a syndicator, is that it?
Who wants to be like you?
Someone who wants to be like me. Maybe my first piece of advice is try to be like somebody else. So once you've gotten past that, but seriously, I would say if you're starting on your passive investing journey, you're just starting, the first thing you want to do is determine whether you should be passive or active. That's the most important thing you have to decide immediately, because what I tell people is that if you choose the wrong path and go 4 or 5 deals deep on the wrong path, you're in a liquid investment in real estate. You can't just sell it all on a stock screen and get your cash out in 3 days, right? So now, if you want to try to reverse course, you've now applied capital to an active or passive scenario that you can't rewind from, especially on this passive side where you can't just go sell your shares. It's very hard. It's actually illegal to sell your shares for the first year, for example. There's anti-flipping laws. After that, you may need to take a loss. You got to find your own investor. It might be rights of refusal. It might be very challenging. So determining which is the better fit for you first is the number one thing you want to do. Assume you've done all that and you've decided to go down the passive route. I would say step one is take a lot of time to learn and focus on one asset class first. A lot of people like starting with multifamily first because it's very relatable. It's an easier asset class to understand than senior living or self-storage from a running the business perspective. And it's something people can relate to because almost everyone's lived in one, right? So you can kind of get your arms around the business model very quickly. There's a lot of them out there and they're easy to comp out and everything because there's just a lot of buildings around. So choose one asset class, focus on it, get what I call a lot of opportunity exposure, which is go and download, even from the crowdfunding websites, if you have no intention of investing through an intermediary, log on if you're an accredited investor to Realty Mogul and other places, and in your pajamas, you can get 10, 20 apartment deals tonight in like an hour. And then put them all next to each other, analyze them all, look at the similarities and the differences, and get to learn the asset class. And the little things you find, those little differences are what are going to be your very important learnings to know what to look for and then stay away from. And I call it learning through opportunity exposure, which is what I did essentially. That's how I started. And then go down the path on a first asset class, but be very careful. Take a lot of time to learn first, and then eventually expand into other asset classes. The good news is that even if you only know apartments today, most of the asset classes have a lot of similarities across them. You can apply an expense ratio, you can apply a rent and expense inflation increases, you can apply an exit cap rate. There's a lot of things you can apply. Upfront capital expenditures, they're all transferable. And then you tweak for each asset class as you get the understanding for it in terms of what you're looking for. But do start with one asset class to keep it simplified. Take enough time to where you're practically 100% comfortable going into the first deal, and don't just go blind and go into a deal because your friend is going into it. It doesn't mean it's a bad deal or a good deal, but it also may not be the right fit for you, right? Even what I focus on may not be the right fit for the next person, and it doesn't mean that either of us are wrong or right, but you got to do what's best for you. And you may even get the gut feel that one sponsor isn't the right fit for you, but somebody else gets the gut feel that is the right fit for them. And you shouldn't move forward if it's not the right gut feel for you, even though it's the right gut feel for your friend, right? So it's really important to evaluate stuff on your own and not just blindly go into things, and really understand what you're getting into because of the illiquid nature and the fact that you're giving control to somebody when you invest with them on the passive side. So sorry that was a little long, but those are some of the things.
Excellent. I've got tons of questions here, but we committed you till 6 o'clock. So I want to ask you, if somebody wanted to get a hold of you, and I know you don't want 65, 66 people calling you. If somebody had a question, wanted to get a hold of you, how would they do that?
Sure. So the best way to reach me is my email, which is jroll, JROLL, @Roll Investments, ROLL Investments with an S.com. So jroll@rollinvestments.com. And honestly, Julie, like, people are welcome to reach out to me. One of the things I've done to try to actually reduce my schedule is I've recently created what I call a Q&A call, which I'm just testing this month for the first time, where instead of having individual calls with everybody, which is what I used to do, I'm actually doing a call every 2 weeks, for an hour if people have specific questions. That's how I handle the questions now, just to try to make it more efficient, and people can learn from other people's questions too. So I have that, for example. People welcome to join that, but people can reach out to me for any reason. It's really not a problem.
You have been so generous with your time and your all of the information that you've shared with us. I am so honored to have you here to share you with all of our people here on Zoom at 8. And I hope that, at some point, that somebody here who has 7 transactions will be able to bring it to you because they were inspired by you and what you shared with us tonight. So thank you so much.